Mahesh Patil now joins in from Aditya Birla Sun Life. He's here to chart out the course of the market. And Mahesh, what's the sense that you're getting? That feeling of despondency does seem to be very evident in the markets, despite all that's been done from the finance minister. Do you think that sentiment or the undertone of the market, despite the FBI tax rollback, etc., continues to remain rather negative?
No, I would say that the market was expecting that some response from the government. I think that is heartening that the government has taken cognizance of the fact that there is a problem in the economy, there is a slowdown, there's a lack of confidence, which is there across investors, business. And I think the recent last couple of days, the government trying to address those issues has given some kind of a confidence back in the market, I would say, at least in terms of trying to avert the downfall, the downward spiral, what we were seeing in the market. I think that to some extent has got arrested. I don't think the measures would really lead to any kind of a uptick in the economy or any big stimulus which is there. But I think some of the confidence boosting measures should clearly help to stabilize the market over here. And then I think one has to wait and see how things move up in the economy in the next couple of quarters. I think that would really decide the course of the market from here on.
Sure. Mahesh, there's a sense that despite all of this and given the current global backdrop as well as the kind of slowdown we've experienced here, not only is it a fact that it might still take a couple of quarters to see it reflected in earnings, but that sentiment is still very wary right now. Would you agree?
Yeah, I would agree that I think there is nothing much to cheer about from the economic standpoint or from the earnings growth standpoint. Things are looking weak. We've seen the last quarter numbers, and even as we get into this quarter, doesn't like it will change materially. So I think from that perspective, and also the fact that the overall lending market, even in the banking side, we've seen some amount of stress again starting to build up. I mean, we would have thought that the corporate NPA cycle has peaked out. But I think in the last 1 month, we've seen some increase in stress in some of the mid-corporates, some of the NBFCs. And that has cast some kind of negativity even on the banking system, banking stocks, which were doing reasonably well. So I think we need to really see how things again come back in the lending market. I think that is crucial, where the credit markets have kind of frozen up. So that liquidity which is there, and what RBI has given the kind of capitalize in the PSU bank, that money has to start flowing back into the system and lending forward. If I think that starts to happen, I think then we'll see some of the easing of availability of credit will be better, the credit spreads would come down, and that will help to slowly revive the economy. But again, it's going to take some time. I think the government fiscal, while they've got the money from the RBI, it's just about enough to really take care of the shortfall which would be there in terms of tax revenues. So there's not going to be much stimulus coming in from the government to really prime the economy. So it's going to be a slow and gradual recovery from here on. And to that extent, the markets would remain kind of a bit subdued. And again, on the global front also, I think the news flow continues to remain a bit volatile. So I think it will take some time for market to really settle down around these levels before we see any kind of a positive move.
Yeah. You know, Mahesh, just wondering, because the sound bites that we're getting is that right now is the time to bet on the mid and small caps. Would you recommend at all to any of your unit holders to try and maybe get out of large cap and multi-cap schemes and maybe increase their allocation or make fresh allocations, whichever the case may be, to any of the mid and small cap funds?
So I think if you look at purely from a valuation perspective and relative valuation vis-a-vis the historical levels, the mid and small cap definitely look attractive compared to the large cap if you look at the indices as a whole. But again, I would say that there is a lot of divergence which is there. There are a lot of large cap stocks also, which are looking attractive, while the headline index might not look as attractive in terms of PE multiple. There is clearly definitely good value emerging in the small cap and mid cap space. So I think, it makes sense to look at this sector, which has been a huge underperformer in the last 1.5 years, and there is clearly value which is emerging. Currently, there is lack of interest in that space, and we're seeing some of the stock prices going down despite no change in the fundamentals. So it will be a good time to start accumulating in the mid and small cap space. And even from an asset allocation perspective, we would recommend somebody who doesn't have enough exposure to small and mid cap to start allocating over there. But I would not advise somebody to really go aggressive on the small and mid cap space at this point in time. I mean, unless there is a clear clarity in terms of how the economy is shaping up over the medium term and long term. I think it would be wise to really make some allocation to mid and small cap space. I would not advise somebody to move out from multi-cap fund. I think a larger allocation in this kind of a market environment should be towards a multi-cap fund, because that provides a good opportunity to look at the undervalued stock both in the large cap and the mid and small cap space. But clearly, if you're under allocated in the mid and small cap space, it is a good time to start making some investments now.
Okay, so clearly there is some opportunity within the mid and the small caps, but I just want to understand, everyone's talking about this overall private sector capex revival. Can you give us some sort of a timeline, or what do you think needs to be done in order to address the concerns or the slowdown that we're seeing? Because sector by sector, be it autos, be it FMCG, everyone's acknowledging it and clearly feeling the pain.
So I think the capex recovery, there are two drivers to it. One is the demand has to pick up so that the capacity utilization levels in various sectors reach a level where people will start investors, the entrepreneurs will start investing into fresh capex. So you were seeing the demand pick up in the early part of this calendar year. We were hopeful that it should gain momentum going forward, but that has clearly slowed down in the last 1 or 2 quarters. And to that extent, I think the capacity utilization levels, which overall at the aggregate level in the economy, we were expecting that to inch closer to 80%. I think that will probably get pushed away by another 6 months or so. And it's also about the confidence level, the level of confidence at the business level, the entrepreneur level, the promoter level is currently a bit low. There is some uncertainty around on the global front also. And a lot of the promoters we're seeing who have leveraged at the individual level are feeling a lot of stress at this point in time because they're not getting rollover. So in this environment, I think the capex, private sector capex, would take some more time to pick up, probably another 15 to 18 months where you could see that really picking up. Obviously, in a few sectors, we have seen probably early recovery, like for example, in the cement sector, in the oil and gas, the PSUs definitely are stepping up the capex. I think again driven by the government. But overall, private sector capex, I think will take another 15 to 18 months to really start showing an improvement.
Okay, let's talk about those individual sectors as well. The small ticket consumer discretionary is what you like, the likes of durable, apparel and footwear. What makes you optimistic on the sector?
So I think the way the government is trying to go ahead is to see that there is a wealth transfer from the rich to the bottom of the pyramid, the poor. And a lot of these small ticket consumer discretionary items where we think the penetration levels are still low and the availability of some of these goods was not available to some of the individuals in the tier 3 and the rural areas. So that penetration is increasing. Also, the fact that the unorganized sector in a lot of these categories, the unorganized sector was much higher percentage. So the gains from the unorganized sector will help to drive growth in this segment for a lot of these companies, much higher than the overall GDP growth. So it looks to be a good long-term secular growth story. And again, the companies here are having, some of these have very strong brand, good distribution network, which will help them to really consolidate their market share. And overall return ratio for these companies are fairly healthy. They generate good free cash flow. So it's a sector which offers a steady growth over the longer term at an environment where we are seeing there is a kind of a slowdown in various areas. So I think from that perspective, in terms of driving penetration, per capita income going up, and a reasonable return profile in this in these companies, make them a good investment opportunity from a long-term perspective.
Great to have you in the studios with us. Thanks so much for taking the time out and speaking with us today.